The $67 billion utility merger risk urges business leaders to strengthen their energy strategy and secure regulatory success. You are witnessing an unprecedented consolidation of the power sector under a definitive all-stock merger agreement valued at $67 billion. This historic corporate combination merges NextEra Energy and Dominion Energy to officially establish the world's largest regulated electric utility by market value. When you factor in inherited liabilities and operational debt, this transaction creates an infrastructure colossus boasting a total enterprise value exceeding $400 billion. L-Impact Solutions stresses that you must look beyond mere corporate scale. This deal represents a high-stakes play for absolute control over the fundamental economic infrastructure of North America. If your business relies on this grid, you will be dependent on a unified entity serving an expansive base of approximately 10 million customer accounts. Your long-term operational costs will be directly tied to a corporate fleet managing a massive 110 gigawatts of total electricity generation capacity. You must navigate a utility business model engineered for absolute stability, with over 80% of its core operations entirely isolated within regulated frameworks. This massive consolidation hits the market precisely as you confront the single largest structural escalation in macroeconomic electricity demand seen in decades. You are seeing grid limits pushed to the brink by the simultaneous compounding of enterprise artificial intelligence, hyperscale data centers, advanced manufacturing, and electric vehicles. If you operate within Virginia, Florida, North Carolina, or South Carolina, you are situated directly within this combined entity's primary geographic power base. You must recognize that Virginia has structurally transformed into the single largest concentrated cluster of hyperscale data centers anywhere on the globe. To understand the sheer velocity of this demand, you must evaluate Dominion's staggering 51 gigawatts of contracted future data center-related demand in its backlog pipeline. You should note that this 51 gigawatt volume represents a massive threefold expansion over the total data center capacity the utility held under contract as of mid-2023. This total pipeline reflects an aggressive 2.5 gigawatt short-term surge, following corporate filings from late 2025 that previously tracked a 48 gigawatt capacity. You are operating in a landscape where U.S. utilities are collectively forced to allocate hundreds of billions of dollars toward transmission upgrades and grid reinforcement. The merging entities are leveraging this unprecedented scale to project a highly ambitious 11% annual growth rate in their regulatory capital employed. You will see the combined executive team target a disciplined adjusted earnings growth rate of more than 9% to satisfy institutional shareholder expectations. To pacify state utility commissions and clear strict regulatory hurdles, the corporations have put forward a substantial $2.25 billion consumer bill credit package. L-Impact Solutions explicitly warns you that financial scale is too often substituted for public benefit, yet outsized monopolies do not automatically yield optimized energy markets. You must recognize that excessive market concentration invariably expands regulatory blind spots, complicates oversight, and erodes the competitive pressure required for operational excellence. While a $2.25 billion short-term credit package appears meaningful, you must calculate total lifetime consumer costs rather than relying on temporary corporate concessions. You should calculate that necessary grid investments over the next 20 years will inevitably demand capital outlays, totaling many multiples of these initial billing credits. As an executive, you must proactively guard against severe integration risks, including multi-year technology harmonization delays and complex workforce restructurings. You are forced to deploy capital under elevated interest rate structures relative to pre-2022 conditions, which continually inflates the cost of financing capital-intensive assets. Your infrastructure procurement budgets are absorbing severe blows from persistent localized inflation affecting high-voltage transformers, transmission lines, and specialized engineering labor. If your 10-year corporate strategy assumes that enterprise AI scaling and data center buildouts will expand linearly without architectural disruption, you are courting catastrophic risk. L-Impact Solutions firmly advises you to view exhaustive scrutiny from federal agencies like FERC, the NRC, and the DOJ Antitrust Division as an indispensable market safeguard. You must demand that this historic combination be executed as a critical national infrastructure transformation rather than a standard corporate acquisition. You need to brace for a combined management team that will directly dictate capital investment programs projected to surpass $100 billion over the next 10 years. To insulate corporate balance sheets from systemic waste, the utility must mandate that every single capital project exceeding $500 million undergo exhaustive return on invested capital, ROIC modeling. You are participating in an energy market where U.S. electric utilities are collectively projected to deploy between $1.5 trillion and $2.0 trillion in grid capital through the year 2050. To enforce authentic long-term consumer affordability, executive leadership must commit to concrete 5- and 10-year targets aimed at slashing core operating expenses by 3% to 5%. You must insist on the deployment of aggressive strategic sourcing initiatives that hold annualized customer rate increases strictly below regional core inflation benchmarks. The U.S. Department of Energy explicitly projects that national electricity demand originating from data center infrastructure could virtually triple by the year 2028. You are entering an era where data center infrastructure alone is on track to consume up to 12% of the total aggregate electricity generated across the United States. To neutralize the threat of catastrophic wide-area blackouts, the utility must immediately prioritize advanced distribution automation and utility-scale battery energy storage systems, BESS. You must mandate a comprehensive zero-trust network architecture and absolute operational technology, OT, segmentation as cyberattacks targeting the national grid surge annually. To ensure reliable access to low-cost capital, the utility must maintain ironclad investment-grade credit ratings and staggered debt maturities to minimize refinancing exposure. You should require completely transparent quarterly public disclosures that openly track integration milestones, capital efficiency, and standardized SAIDI and SciFi reliability metrics. L-Impact Solutions maintains that your executive leadership team must continuously stress-test energy procurement strategies against multiple, highly divergent AI commercialization pathways. You cannot afford to ignore systemic supply chain paralysis, particularly when large power transformers currently carry severe manufacturing lead times of 18 to 36 months. To insulate operations from geopolitical procurement friction, the board must lock in long-term supplier agreements and diversify geographic sourcing for specialized substation assets. You must enforce mandatory, multivariable financial stress testing against sustained high interest rates and multi-million-dollar construction overruns before approving any capital campaigns. Regulators must aggressively transition away from legacy frameworks and adopt performance-based regulation that ties corporate revenue directly to verifiable grid uptime and reliability targets. Corporate governance demands that the board establish a dedicated strategic resilience committee tasked with overseeing cyber defense, climate adaptation, and enterprise risk management. L-Impact Solutions emphasizes that the definitive benchmark of this merger's success is not transaction volume or asset valuation, but the long-term delivery of verifiable consumer affordability. The United States is entering an unprecedented capital allocation cycle requiring hundreds of billions of dollars annually across generation, high-voltage transmission, and digital infrastructure. Unprecedented scale yields a genuine strategic advantage for your organization only when it is matched by unwavering governance discipline, operational resilience, and absolute regulatory credibility. You can look at this intense regulatory review process as a definitive historical blueprint to codify the exact governance metrics that all future utility megamergers must satisfy. If you operate as an institutional investor, you must rigorously audit whether this consolidated management team translates its theoretical operational synergies into measurable margin expansion. You must track this entire transaction closely as it moves toward its official projected closing date in mid-2027 following exhaustive federal and state reviews. The precedents established during this specific integration phase will directly dictate the structure of your corporate energy procurement contracts for the next 2 decades. You must recognize that the sheer dominance of this consolidated utility will structurally alter the balance of power between industrial energy consumers and grid operators. If you want to eliminate the risk of stranded asset allocation, your long-range demand forecasting matrices must be vastly more diversified than legacy utility planning software. You must factor in critical macro hedges, including accelerated distributed generation, aggressive commercial rooftop solar deployment, and exponential computing hardware efficiency gains. Protecting the broader economy requires that the promised $2.25 billion in consumer rate relief be distributed with absolute equity across Virginia, North Carolina, and South Carolina. You must closely observe how the Nuclear Regulatory Commission audits the structural safety and operational continuity of the massive combined nuclear generation portfolio. The ultimate macro trajectory of domestic semiconductor manufacturing and industrial reshoring in North America hinges entirely on the baseload reliability of this unified grid. You must treat uncompromising capital allocation discipline as the single most important operational pillar for all post-merger corporate execution. Ultimately, you are witnessing the permanent rewriting of the ground rules governing the modern energy economy, and your corporate strategy must rapidly evolve to survive this new reality. Will your energy strategy survive a $75 billion utility merger? Comment below. For more strategic analyses, visit our business consultancy website, link in the description below. Thank you.